Hello, friends. Today's topic is for expatriate Americans. As you know, under federal tax law, a U.S. citizen is taxed on their global income, whether earned in the USA or anywhere in the world. So filing a tax return is obligatory for expat Americans. Yes, there are special credits, the foreign tax credit or foreign earned income exclusion, that help minimize the taxation for expat Americans. However, this video topic is whether state income tax return filing is also an obligation for expat Americans who are not living in the USA. Well, you will be surprised to know that there are 4 states that require tax filing, even if you do not stay there. So here is the list of those 4 states with important points on imposing state taxation on non-resident expat Americans or those living in other states. First on the list of states that tax non-residents is California. If Americans living abroad were residents of California at any point in the tax year, they are likely considered part-year residents and will be taxed on worldwide income for the period in which they lived in California, plus any California-based income they might have received while living elsewhere. The California Franchise Tax Board, FTB, looks at each case individually to determine if expats who previously lived in California are required to continue paying California state taxes. The 2 most common instances in which expats who previously lived in California are required to continue paying California state taxes are 1. If they still have income sourced in California, or 2. If they have not established residency in another state. It should also be noted that unlike the federal tax rule, expats can't apply the IRS foreign tax credit or foreign earned income exclusion to their Californian state tax bill. The Safe Harbor Rule allows expats who move abroad for at least 546 consecutive days on an employment contract to not be considered state residents. However, the Safe Harbor Rule will not apply to a case if the expat Americans have passive income of over $200,000 in a year while they're abroad, or if they are moving abroad with the sole aim of avoiding taxes. That was about the California state tax rule on expat Americans. Let us move to second state that taxes non-resident expats. The second state on the list of 4 is New Mexico. If you were previously a resident of New Mexico, they may still consider you a resident for tax purposes. The residency of Mexico is determined if either of the 2 conditions are satisfied. 1. Your domicile is located in New Mexico. You may own or rent your domicile, or it may be a place where you are allowed to stay free of charge, such as a relative's house. 2. You are physically present in New Mexico for at least 185 days during a single year, regardless of where your domicile is. So even if you are an expat American living abroad, or even a U.S. citizen living in another state, but maintaining a domicile in the state of New Mexico, you will be taken as resident for tax compliance. The state tax law requires every resident to file a tax return if they are legally bound to file a federal tax return. Third on the list is South Carolina. This state taxes you on all your worldwide income if you are domiciled in the state, even though you may not be a resident there. And note the most important point: any person, whether an expat or not, if found to be a tax resident of South Carolina, will have to pay and file a state tax return. According to the South Carolina Individual Income Tax Guide, if you were a South Carolina resident who moved away for a temporary or indefinite period of time without intent of making the new place your home, then you are still a South Carolina resident. So how do you determine if you are a tax resident of South Carolina? Simple. See if you fit in any of the 3 situations. 1. Your intention is to maintain South Carolina as your permanent home. And 2. South Carolina is the center of your financial, social, and family life. And 3. When you are away, South Carolina is the place to which you intend to return. Simply leaving the state and establishing residence elsewhere is not enough to change your domicile. You must also intend to remain in that new locality and take steps to change it to your new domicile. Any person, whether an expat or not, if found to be a tax resident of South Carolina, will have to pay and file a state tax return. According to the South Carolina Individual Income Tax Guide, if you were a South Carolina resident who moved away for a temporary or indefinite period of time without intent of making the new place your home, then you are still a South Carolina resident. Last on the list is Virginia. The domiciliary residents need to file and pay taxes to the state of Virginia, similar to tax residents. Who is a domiciliary resident? If you fulfill any of the following 3 conditions, you will be regarded as a domiciliary resident. 1. An individual who enters the military from Virginia, i.e., claims Virginia as his/her home of record, will remain a domiciliary resident of Virginia. 2. A student who attends school in another state but maintains Virginia as his/her legal state of residence is a domiciliary resident. 3. A resident of Virginia who accepts employment in another country is a domiciliary resident. A Virginia resident's return must include income from all sources. No subtractions are allowed for income reported to other states. Income taxes paid to other states are addressed through tax credits. No tax credits are allowed for income taxes paid to foreign countries, except on foreign source pension income. In addition, no tax credits or deductions are allowed for taxes paid to any city, county, or other local government, or to the federal government. Thank you for watching the video. If you liked it, do us a favor by subscribing to our channel and clicking the bell icon.